Just hours ago, a quiet financial decision confirmed what U.S. policymakers have feared for decades. It wasn't dramatic, it wasn't loud, but it will reshape how the global economy functions for years to come. And whether you realize it or not, it will directly affect your job, your savings, and your standard of living. Most headlines won't explain this properly. So let me break down exactly what just happened and why it matters more than you think. Welcome to the Financial Codex, decoding the financial forces shaping your future. Just hours ago, a quiet financial decision confirmed what U.S. policymakers have feared for decades. It wasn't dramatic. There were no emergency press conferences, no stock market collapse, but it may reshape how the global economy functions for years to come. And whether you realize it or not, this shift will directly affect your job, your savings, and your standard of living. Most headlines will not explain this properly. They will focus on surface-level politics, short-term market noise, or familiar personalities. What they will not explain is the system underneath, the structure that has quietly determined how money moves, who benefits, and who absorbs the cost. So let's break down what just happened and why the consequences are already in motion. For more than half a century, the global economy has operated inside a financial arrangement unlike anything before it. At the center of that arrangement sits the U.S. dollar, not simply as a national currency, but as the foundation of international trade, global savings, and financial stability. This status did not happen by accident. After the collapse of the gold-backed monetary system in the early 1970s, the United States entered a new era. The dollar was no longer tied to a physical constraint. Instead, it became a trust-based instrument, accepted worldwide not because it could be exchanged for gold, but because the world believed in the political, military, and economic dominance of the United States. That belief created a powerful advantage. Because global trade relies on dollars, other nations must earn them. Because commodities like oil are priced in dollars, countries must hold them. Because international reserves are stored in dollars, central banks depend on them. And as long as that demand exists, the United States can borrow, spend, and expand with fewer immediate consequences than any other nation in history. This arrangement allowed America to finance massive trade deficits year after year. It allowed military expansion across the globe. It allowed tax cuts, bailouts, and emergency spending without the same level of constraint faced by other economies. But every system built on trust contains a weakness. Trust does not collapse all at once. It erodes, quietly, gradually, almost invisibly. And that erosion begins when participants start asking a simple question: is this system still safe for us? Over the past decade, that question has been asked more frequently, not by commentators, but by governments, central banks, and financial planners whose job is to think in decades, not news cycles. What they have seen is a world where financial power is increasingly weaponized, where access to payment systems can be cut, where reserves can be frozen, where currency dominance is no longer neutral, but strategic. And once that realization takes hold, behavior changes, not suddenly, not recklessly, but deliberately. What you are witnessing now is not a collapse, it is a repositioning, and history shows that when major players reposition themselves inside a global system, the outcomes rarely remain contained at the top. They travel downward, into markets, into prices, into wages, and eventually into everyday life. This is the point where most explanations stop, but this is where the real story begins. To understand why the current shift matters so deeply, you first need to understand how the dollar-centered system actually works, not in theory, but in practice. At its core, the dollar's power comes from demand that exists outside the United States. Nations need dollars not because they admire America, but because global trade is structured in a way that requires them: oil, natural gas, food commodities, industrial materials, and shipping contracts are overwhelmingly priced in dollars. If a country wants to function in the global economy, it must acquire and hold dollars. This creates a unique loop. Foreign countries sell goods to the United States. In return, they receive dollars. Those dollars cannot simply sit idle. Holding large amounts of cash is inefficient and risky. So governments and central banks invest. those dollars most often into U.S. Treasury bonds. In effect, the rest of the world lends money back to the United States. This is how America has been able to run persistent trade deficits for decades. It buys more than it sells, yet remains financially stable because foreign surplus dollars are recycled into U.S. debt. The system funds itself. No other country enjoys this privilege. If most nations attempt to borrow excessively or run large deficits, investors demand higher interest rates or pull away entirely. Currencies weaken, inflation follows, crises emerge quickly. The United States, by contrast, has been able to delay those consequences, not eliminate them. Delay them. This is what economists refer to as the exorbitant privilege of the dollar. It allows the U.S. government to finance military expansion, social programs, corporate bailouts, and tax policies without immediately confronting the limits faced by other economies. It also allows American consumers to enjoy lower prices on imported goods, as foreign producers accept dollars in exchange for real labor and resources. But this privilege is not free. It comes with an obligation. The dollar must remain trusted, accessible, and politically neutral in the eyes of the world. For decades, that condition largely held. Even during geopolitical tensions, financial systems were treated as separate from conflict. Reserves were respected. Payment networks were considered infrastructure, not weapons. That separation no longer exists over the past 20 years, and especially after the global financial crisis and subsequent geopolitical conflicts. The dollar system has been increasingly used as a tool of enforcement. Nations have been removed from payment networks. Assets have been frozen. Transactions have been blocked. From Washington's perspective, these tools are effective. They allow pressure without direct military engagement. But from the perspective of countries holding large dollar reserves, they represent a dangerous precedent. A reserve asset is supposed to be safe precisely because it is boring, predictable, and untouchable. Once it becomes conditional, once access depends on political alignment, it stops being a neutral store of value. This is the moment when long-term planners start looking for exits, not because they want to destroy the system, but because their responsibility is to protect national savings from future risk. And here's the key insight most discussions miss. A global reserve system does not collapse when confidence disappears. It weakens when alternatives become possible. You do not need a perfect replacement for the dollar. You only need enough options to reduce dependence. Gold, regional trade settlements, local currency agreements, independent payment systems. Each move on its own seems insignificant. Together, they change incentives. Once the incentive to hold ever-growing amounts of U.S. debt declines, the balance that sustained the system begins to shift. And that brings us to the decision that signaled this change most clearly. When China began reducing its holdings of U.S. Treasury bonds, it was not acting out of panic, retaliation, or short-term politics. It was acting out of calculation. For years, China was the single largest foreign holder of U.S. government debt. At its peak, those holdings exceeded $1 trillion. In practical terms, China was financing a significant portion of America's borrowing, quietly, consistently, and at enormous scale. This arrangement often gets described as a mutually beneficial relationship. The United States received cheap financing. China gained access to American consumers. On the surface, this explanation sounds reasonable, but it ignores a critical imbalance. China did not accumulate dollars because it preferred them. It accumulated dollars because the global system required it to. Running large trade surpluses with the United States meant receiving dollars in exchange for goods. Those dollars then had to be invested somewhere. For decades, U.S. Treasury bonds were the only market large enough, liquid enough, and stable enough to absorb those flows. That convenience slowly became a constraint. By holding such vast reserves in U.S. debt, China was effectively placing a large portion of its national savings under the control of a geopolitical rival. As tensions between Washington and Beijing increased over technology, trade, military influence, and Taiwan, that exposure began to look less like prudence and more like vulnerability. The turning point was not theoretical, it was observed. When Western governments froze hundreds of billions of dollars in Russian central bank reserves, Following the invasion of Ukraine, a precedent was set, regardless of one's view of the conflict. The message was unmistakable. Dollar-denominated assets are only secure as long as they align with U.S. strategic interests. From that moment on, holding large dollar reserves carried a new kind of risk. China did not respond dramatically. It did not dump its holdings overnight. That would have damaged both markets and its own balance sheet. Instead, it did what strategic actors do. It adjusted gradually. Year after year, China reduced its exposure. Hundreds of billions of dollars were redirected away from U.S. treasuries into other forms of storage and settlement. Gold purchases increased. Bilateral trade agreements expanded. Currency swap lines multiplied. At the same time, China invested heavily in infrastructure designed to operate outside U.S.-controlled financial channels, alternative payment systems, direct settlement mechanisms, yuan-denominated trade routes. None of these moves individually threatened the dollar's dominance, but together they sent a signal. China was no longer trapped, and that signal did not go unnoticed. Other nations, facing similar concerns, began to reconsider their own positions. Japan slowly reduced its holdings. Oil producers explored non-dollar pricing. Emerging markets expanded local currency trade. Central banks across the globe accelerated gold accumulation. What matters here is not intent, but imitation. Financial systems are built on shared behavior. Once one major player demonstrates that diversification is possible without catastrophe, others follow. This is how systemic change begins. Not with a collapse, with a precedent. China's decision was not an attack on the dollar. It was an insurance policy. And insurance policies only become necessary when perceived risk increases. That rising perception, that dependence on a single financial authority carries long-term danger, is the real story unfolding beneath the headlines. Because once enough participants start managing for that risk, the system they are hedging against begins to change. And that change has consequences, not just for governments and markets, but for ordinary people who never voted on the structure of the system in the first place. As foreign demand for U.S. government debt slowly weakens, a fundamental problem comes into focus. The United States is borrowing more than ever, not less. Annual budget deficits now measure in the trillions. Interest payments on existing debt alone consume a rapidly growing share of federal spending. This means the government must issue new debt simply to service the old one, before funding any public services, defense, or emergency programs. Under normal conditions, declining demand would force painful adjustments. Spending would be reduced, taxes would rise, or borrowing would become more expensive. But the United States has a backstop. When foreign buyers step away, the Federal Reserve steps in. The central bank can purchase U.S. Treasury bonds directly, stabilizing markets and ensuring the government remains funded. Technically, this is called open market operations. Practically, it means creating money to absorb debt that others no longer want. This process does not immediately feel dangerous. In fact, it often feels necessary. Markets remain calm. Government functions continue. Crises are avoided. But the cost does not disappear. It moves. When new money enters the system at scale, it does not spread evenly. It flows first into financial markets. Asset prices rise. Stocks, real estate, and investment vehicles inflate. Those who own assets benefit. Those who rely on wages do not. This is why periods of aggressive monetary expansion often coincide with rising inequality. Living costs increase faster than incomes. Savings lose purchasing power. Essentials become harder to afford. We saw this dynamic clearly during the pandemic period. The Federal Reserve expanded its balance sheet by trillions of dollars in a short time. The result was not abstract. It was felt in grocery stores, gas stations, rent payments, and insurance premiums. Inflation became a daily experience, and while headline inflation numbers eventually moderate, the price increases remain. Costs reset upward. Wages rarely catch up. This is the hidden mechanism through which debt is paid, not through explicit taxation, but through reduced purchasing power. As foreign buyers reduce their role, this mechanism becomes more central. The uncomfortable reality is that the United States cannot easily reverse this trajectory. Slashing spending is politically dangerous. Raising taxes at scale is unpopular. Reducing military commitments is strategically sensitive. So the path of least resistance remains monetary support, but that path carries long-term consequences. As reliance on the Federal Reserve grows, confidence in fiscal discipline weakens. Investors begin demanding higher yields to compensate for inflation risk. Higher yields increase interest costs. Higher interest costs require more borrowing. The cycle feeds itself. This is how debt problems rarely explode suddenly. They grind forward, slowly, and as they do, the burden is passed downward. Consumers pay more for necessities. Public programs face pressure. Infrastructure ages. Social tensions rise as living standards stagnate. None of this requires a financial collapse to be damaging. It simply requires time. The more the system relies on monetary expansion to maintain stability, the more stability becomes an illusion, maintained in markets while eroding in daily life. This is the price of a system that was designed for abundance, but now faces limits, and it leaves the United States with a narrowing set of choices, none of them painless. At this point, the question is no longer whether the global financial order is changing. That question has already been answered. The real question is how the transition unfolds and who absorbs the cost. There are several paths forward, each carrying its own risks. One possibility is a gradual acceptance of a multipolar monetary world. In this scenario, the dollar remains important, but no longer dominant. Trade settles across multiple currencies. Reserves are diversified. Financial power becomes more distributed. This would require restraint. It would require cooperation, and it would require the United States to accept limits on the privileges it has enjoyed for decades. History suggests this outcome is unlikely. Another possibility is resistance, the attempt to preserve dollar dominance through pressure, sanctions, and financial enforcement. This path seeks to delay change by making alternatives costly. But pressure accelerates innovation. Every restriction encourages workarounds. Every frozen asset strengthens the incentive to build systems beyond reach. What begins as enforcement ends as fragmentation. A third path is internal strain. Continued borrowing, continued monetary support, rising debt service through inflation and declining purchasing power. This path does not end in a single dramatic event. It ends in slow erosion of trust, of stability, of confidence. This is the most familiar path. Empires rarely collapse suddenly. They adjust downward. The final and most likely outcome is a combination of all three, a world divided into financial blocks, regional currencies, separate payment systems, reduced interdependence, higher friction, less efficiency, more uncertainty. In such a world, no single nation controls the system, but no single nation shields itself from volatility either. And this is where the story returns to China's decision. China did not announce a new order. It did not challenge the dollar directly. It simply reduced its exposure. That choice mattered because it demonstrated something critical. Dependence is optional. Once that realization spreads, behavior changes, capital moves, incentives shift, not because of ideology, but because of risk management. For ordinary people, these shifts are rarely visible at first. They show up later in higher prices, fewer opportunities, tighter budgets, and growing anxiety about the future. The system people were raised inside begins to feel less reliable. And what makes this moment especially important is that it was not unpredictable. The contradictions were always there. Borrowing without limits, consuming without producing, power backed by confidence rather than constraint. What is changing now is not the structure itself, but the willingness of others to carry it. Once that willingness fades, the system does not collapse. It adjusts quietly, unevenly, and often unfairly. By the time the effects are fully understood, the decisions that set them in motion are already years in the past. That is the nature of financial power. It moves first in silence and speaks later through consequences. If this helped you see this system more clearly, subscribe to the Financial Codex.